inflation is still, core inflation is still well above target on a 12-month basis. 12 months is our target. Certainly, I'm encouraged, and we're encouraged by the progress, but we're not declaring victory at all at this point. We think we have a ways to go.
Thank you, Mr. Chairman. You've said that you would know the neutral rate by its works. So I'm wondering what you could tell me. How do you believe the neutral rate is working? We're telling you right now that growth is stronger. In other words, how much is the economy really being restrained right now by the current funds rate? And how much restraint does it really need additionally if inflation is still coming down?
So I think you do see in the interest sensitive parts of the economy, you do see, for example, housing, you see the effects. Your second question though really I think is important, and that is a lot of this has come through, a lot of the disinflationary process has come through the healing of supply chains and also of the labor market. So you see that other set of factors is really different from other cycles and has brought that working with tighter policy, which has enabled the supply side to recover, I think is that mixture has been behind what has enabled this. So no, we really do think that we're having an effect broadly across the economy. I would point to the interest sensitive parts of the economy as well as spending generally. But it's a joint story, it's a complicated story.
But how much restraint are you actually imparting to the economy, would you say, relative to the neutral rate?
So I think it's of course, that it's not something you can identify with any precision, but a standard approach would be to take the nominal rate, 5.3%, let's say, and subtract sort of a forward measure of inflation. If you do that, there are many, many ways to calculate the neutral rate, but that's what I like to do. And you're going to get to something that is materially above mainstream estimates of neutrality, of the neutral rate, you will. But at the same time, you look at the economy and you say, this is an economy that grew 3.1% last year. And you say, what does that tell you about the neutral rate? What's happening though is the supply side has been recovering in the middle of this. So that won't go on forever. So a lot of the growth we're seeing it isn't just a tug of war between interest rates and demand. You're getting, more activity because of labor market healing and supply chains healing. So I think the question is when that peters out, I think the restriction will show up probably more sharply.
Thank you. Sorry. Thanks for taking the questions, Mr. Chairman. You mentioned earlier we're not seeking a weaker labor market. I think that you said. Can you talk a little bit more about that? Do you think the labor market now is back to quote unquote normal, and that we can achieve the inflation target without wage gains coming back down to what they were pre-pandemic? Even with today's ECI levels, they were still above those pre-pandemic levels.
I think the labor market by many measures is at or nearing normal, but not totally back to normal. And you pointed to one or more of them. So I think, job openings are not quite back to where they were. Wage increases rather are not quite back to where they would need to be in the longer run. I would look at it this way though. The economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that happens, probably will take a couple of years to get all the way back. And that's okay, But we do see, you saw today's ECI reading, the evidence is that, that wage increases are still at a healthy level, very healthy level, but they're gradually moving back to levels that would be more associated, given assumptions about productivity, or more typically associated with 2% inflation. It's an ongoing process, a healthy one, and I think we're moving in the right direction.
So that process can continue without a weakening of the labor market, basically, you're saying?
Well, I think the labor market is, I don't know if it's rebalancing. Clearly, there was a fairly severe imbalance between demand for workers and supply at the beginning of the pandemic. So we lost several million workers at the beginning of the pandemic from people dropping out of the labor force. And then when the economy reopened, you remember 2021, you had a severe labor shortage, and it was everywhere, panic on the part of businesses couldn't find people. So what's happened is we expected the labor market to come back quickly, and it didn't. And 2022 was a disappointing year. And, we were kind of thinking, well, maybe we won't get it back. And then 2023, we did, as you know. So labor force participation came back strongly in 23, and so did immigration. Immigration came to a halt during the pandemic. So those two forces have significantly lowered the temperature in the labor market to where it's still a very strong labor market. It's still a good labor market for wages and for finding a job, but it's getting back into balance. And that's what we want to see. And, one great way to look at that is what's happening with wage increases. And you see it now across the major things that we track. It isn't every quarter, but overall, there's a clear trend, still at high levels, but back down to what would be consistent with where we were before the pandemic and with 2% inflation.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to follow up on Rich's question. It sounded like you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could re-accelerate from here. And it sounds like you're saying you're not worried that solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk, the risk that inflation would re-accelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here, and why we're not, rushing. So I think both of those are risks, but I think the more likely risk is the one that I mentioned, which is you've had 6 good months, very good months, but what's really going to shake out here? When we look back, what will we see? Will inflation have dipped and then come back up? Are the last 6 months flattered by factors that are one-off factors that won't repeat themselves? We don't think so. That's not what we think, but that's the question we are asking. We have to ask, and we want to get comfort on that.
And just one quick follow-up. Governor Waller had mentioned the revisions that are coming on February 9th for the CPI data. Is that watching as well? And if we see those revisions fairly minor, is that going to give you more confidence where things are going?
We'll just have to see. We'll look at those. Last year was a surprise.
Michael McKee, Bloomberg Radio and Television. If you don't want to use the term soft landing, would you say at least that from your point of view now, other scenario of a hard landing caused by the Fed is off the table, or the risks have diminished very much? And you mentioned below 2% inflation on a 3-month basis. Core PCE has been running at 1.5%. And there are those on Wall Street who think that if you maintain the level of restriction you have right now, you could end up with inflation running below your target. How do you see that?
So your first question, how to describe where we are. So I guess I would just say this. Executive summary would be that growth is solid to strong over the course of last year. The labor market, 3.7% unemployment, indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years. So it's a good labor market. And we've seen inflation come down. We talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation. Let's be honest. This is a good economy. But what's the outlook? That's looking in the rearview. The outlook, we do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. Labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed. And of course, 12%
رهيب الزلمة رهيب
inflation
رهيب
is above target, and getting down closer to target is not guaranteed, but we do seem to be getting on track for that. So those are the risks and questions we have to answer, but overall, it's a pretty good picture. It is a good picture. Your second question was, sorry.
Could you get inflation that is below target, end up with inflation below target, and you have to do something about that?
So the thing is, we're not looking for inflation to tap the 2% base once. We're looking for it to settle out over time at 2%. And the same thing is true. If we have a month or two of lower, and we have that now, of inflation that's annualized at a lower level, that wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have it anchor at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question, which we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for taking this.
مش معقول مش معقول.
I've heard from some district Fed presidents, is it, in your view, a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
So
هلا ليكو
I'll
ما
point
في
to that
جواب.
language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider
عم بيرجع يقراها.
begin to dial back the restrictive stance that we have in place. So if you take that to the current context, we're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, I'm hearing that as March. I would say I don't think that's probably not the most likely case, or what we would call the base case. Then your second question is
Is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be a one-off?
That's going to depend on the data. The whole thing is, this is going to depend on the
ما
data.
في
We're
جواب.
going to be looking at the economic data as it affects the outlook and the balance of risks, and we're going to make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's really going to depend on how the economy evolves. We talked about there are risks that would cause us to go slower. For example, stronger inflation, more persistent inflation. There are risks that would cause us to, or if they happen, that would cause us to go faster and sooner, and that would be a weakening in the labor market, or for that matter, very, very persuasive lower inflation. Those are the kinds of things. So we're just going to be reacting to the data. That's really the only way we can do this.
Victoria. Hi, Victoria Guido with Politico. Could you talk a little bit more about productivity growth? You've mentioned multiple times about, the level of wage growth that's consistent with 2% inflation. We've obviously seen, you were talking about ECI this morning, in which it's cooled a little bit, but still sort of above what you wanted to see. Growth has been very strong. How much of those numbers do you attribute to productivity? And do you see that productivity as sort of just temporary because of the factors, the labor and supply chain factors you were talking about? Or do you think that productivity growth will fade over time?
So this is a really interesting question, and I think my own view is, I think if you look back to the pandemic, you saw a spike in productivity as workers were laid off and activity didn't decline as fast, and then you saw a deep trough of productivity, and then over the last, you saw high productivity last year in 23. I think we're basically in the throes of getting through the pandemic economy, and the question will be, what is it that has changed? The productivity tends to be based on, fundamental aspects of our economy. Is there a case, will it be the case that we come out of this more productive, more on a sustained basis? And I don't know. What would it take? It would take, people talk about AI, but my guess is that we may shake out and be back where we were, because I'm not sure I see work from home doesn't seem like it's a big productivity increaser. AI, artificial intelligence, generative may be, but probably not in the short run, probably maybe in the longer run. So I'm not seeing why it would, but, right now, I would say the productivity is kind of what falls out of the broader forces that are driving people in and out of the labor force and activity returning and supply chains getting fixed.
Right, so would that be behind why we've seen such strong growth, but we've also seen inflation fall, that maybe there's just a higher level of productivity?
That's
right
one
now?
way to look at it, yeah.
That's one way to look at it. يلا.
Marketplace. I want to ask a little bit more about housing. I'm wondering, how closely are you watching rent and housing prices as you evaluate whether and when to cut rates? And it seems like housing prices are not coming down.
Target. We're also well aware that when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry.
And
When
he's
we raise
a
rates,
genius.
the
He's a
housing industry
genius.
can be hurt because it's a very interest-sensitive sector. On top of that, we have longer run problems. with
أبداً
the
Jean-Pierre،
availability of
أبداً.
housing. We have a built-up set of cities.
جون
further
الريت
out,
كات
so
جون.
there hasn't been enough housing built, and these are not things that we have any tools to address. But where it comes into play very specifically in our work is inflation, which is a combination. It's really rental inflation. You're taking owner's equivalent rent and then actual rent paid by tenants, and you're running that through the CPI calculation or the PCE calculation, the one we look at. And what that's telling you is that market rents are increasing at a much lower rate or even being flat, and that will show up in inflation over time. It has to, as long as that remains the case. So.
And just real quick, what is your response to the letter that was sent to you by some members of Congress asking the Fed to lower interest rates to make housing more affordable?
My response is what I started with, which is that our job, the job Congress has given us, is price stability and maximum employment. Price stability is absolutely essential for people's lives. Most importantly, not most important, but mostly for people at the lower end of the income spectrum who are living at the edges, at the margins. And so for someone like that, high inflation in the necessities of life, right away you're in trouble. Whereas even middle class people have some scope.
One of the most devious.
So we have to get, it's our job. It's what society has asked us to do, is to get inflation down. And the tools that we use to do it are interest rates. So that's how we think about that.
Courtney Brown from Akylles. Can you give us some insight into whether the committee discussed the possibility of slowing balance sheet runoff in the months ahead?
Yes. So I would start by saying that balance sheet runoff so far has gone very well. And as the process has continued, we're getting to that time where questions are beginning to come into greater focus about the pace of runoff and all that. So at this meeting, we did have some discussion of the balance sheet, and we're planning to begin in-depth discussions of balance sheet issues at our next meeting in March. So those questions are all coming into scope now, and we're focusing on them, but we're at the beginning of that process, I would say.
Quick follow-up, is it the case that the Fed would decide to lower rates and make adjustments to the balance sheet runoff in tandem?
Yes, we do. We see those as independent tools, and so they don't. For example, if you're normalizing policy, you might be reducing rates but continuing to run off the balance sheet. In both cases, that's normalization. But from a strict monetary policy standpoint, you could say we're loosening and one would tighten. So that could happen. It's not something we're planning or thinking about, but right now we're thinking about getting to a place where we're going to see the balance sheet runoff to continue. We're watching it carefully, and as I said, we'll be looking into that as a committee starting in March.
Thanks.
Simon Urbanovich with The Economist. Thank you, Chair Powell. You've mentioned 6 good months of inflation data, but that not being enough to build up confidence. Based on your previous response that your base case is you probably wouldn't start easing yet in March, the implication is that 8 good months might not be enough either. Roughly how many months do you think you might need of good inflation data to be confident?
Yeah, I'm not in a position to.
Sinking? ما باش sinking. No.
And it's not that we don't have any confidence. We have growing confidence, but not to the point where we feel like It's a highly consequential decision to start the process of dialing back on restriction. We want to get that right, and we feel like the strong economy, strong labor market, inflation coming down, gives us the ability to do that. We think that's the best way we can serve the public, because ultimately, we've made a lot of progress on inflation. We just want to make sure that we do get the job done in a sustainable way. That's how we're thinking about it. In terms of when that'll be, that'll all come out of our communications, and we won't keep that a secret.
Hi, Chair Bell. Evan Reiser with M&I Market News. Can you explain a little bit more on what you're considering when tapering QT? Do you need to see the overnight reverse repo facility all the way down to zero, or is it something that you can start with a couple $100 billion there?
Not a decision that we've made, but I wouldn't think we wouldn't be taking a position that it's got to go to zero. I mean, if it were to stabilize at a different level, but that's not a decision that we've made. That's what we'll be talking about at the March meeting.
True.
A whole range of issues will be briefed up, and the committee will get into all of the issues that will be arising over the course of the next, let's say, year or so.
Great.
Thanks, Greg Robb from Market Watch. Chair Bell, I want to change gears a little bit. In the presidential primary campaign that's been going on
خلاص
for the
هون
last 9
ما
months
بدي
or
اسمعه.
so, your name has come up often, and many Republican
اوكي جايز بس تفسركم ليه عم سمعكم هالشي. عم سمعكم هالشي ahead of اللي بدنا نشوفه اليوم. اوكي لتعرفوا وين كنا وين عم نسير. اوكي ولتشوفوا كيف بده يتحرك الماركت على الاساس. كان بيهمني تسمعوا هيدا الشيء. هلا حنحكي نرجع نحكي بعد الليلة على اللايف تبعنا على تيك توك. بس كتير مهم تفهموا طريقة الحكي، تفهموا شو عم ينقال، طريقة الحكي، طريقة التعامل مع الأسئلة اللي صارت، اللي كيف تبلوروا الأمور من وراء كل اللي صار بالماركتس. حنطلع عشية ونحكي. أنا بعدني بالماركت فبدي أعتذر منكم، بس بدي إياكم تتذكروا اللي قلتوا اللي حضرتوه هلأ، ونرجع نحكي عشية على تيك توك. باي.